Inflation's cooling, recession fears may be fading, so is it time for traders to lean back in? We'll break down expectations, key data to watch, and the sectors that could lead the next move. I'm Johanna Bota, and joining me today is StoneX's Vice President, Global Head of Retail Dealing Desk, Alex Richards. Welcome back, Alex.
Hi, Johanna.
Thank you for joining us. So let's start with what's driving the markets right now.
Well, I think as we entered a new phase, I always talk about phases. For me, we've got earnings season and we've got inflation. I mean, below that, there's still sort of the Donald Trump thing that isn't going away. I mean, it was fascinating yesterday where I was reading something brilliant this morning again and was considering it like a Schrodinger's cat moment. The idea of that there's a cat in the box and the cat is both alive and dead at the same time until you open the box. And it's almost a great analogy for Powell. Oh. He's in the chair, he is there, but he's both alive and dead at the same time. And, in terms of inflation driving the markets, we saw how much the dollar weakened yesterday on the rumours that he was going to be sort of pushed out, and how the dollar has rallied back all the way.
Well, let's stick with inflation then. How are expectations shaping up right now?
On the whole, pretty good. The US CPI came out earlier this week, and we saw it at 2.7%, which again, it's not on target, but close to. And I think, for everyone's fears for a while, all the rumors were, wow, inflation is going to balloon under Trump. And it's really played into Trump's hands that again, we've got that sort of stability. So I think, again, this has enabled him to go to war with the Fed. If inflation was 3-4%, we'd be in a very different position, and Trump would, having to be sort of almost undoing all his policies. Switching to the Eurozone, again, overall at 2% on target. It's almost a thing of a past in the Eurozone where Italy and France were down at 1%. So you can almost, forget inflation there.
And what about here in the UK?
Not quite as good in the UK. We saw an unexpected rise earlier this week. But there's a lot of sort of reasons for that we can look into sort of on delving into it. We saw tax rises are fed through, minimum wage rises are fed through. And what I'm seeing is that last of all, wage growth is going down from 6.2% at the start of the year. We're expecting 5.1% in September again. So, 1.1% wage growth, that's got to feed through, probably to a 1.1% cut in inflation. So what I've been seeing is that the Bank of England, normally they don't like to talk about long-term expectations too much. They'll just say, look, we'll see what happens. They've been really assertive at the moment that inflation will be going back to 2%.
So then with inflation cooling and recession fears starting to ease, does that open the door for traders to step back in with more confidence?
Well, it seems to me, again, talking about phases, we're moving from shocks to guidance. Whereas I think almost before markets in the last, I'd probably say 18 months, they've almost been traded like a cryptocurrency in that way. The idea that cryptocurrencies, there are no fundamentals. If you think of an equity, you've got earnings per share, you've got expected future growth of earnings. You can roughly put your finger on how much a share should be worth, and again, with a bit of fear and greed mixed in. But a cryptocurrency, how much is a Bitcoin worth? There's no right answer. No right answer to that. And I think almost that's been the way that markets have been. There's been no real sort of, you can't put your finger on valuations. It's just been trade the market movements, and again, trade the technical analysis. Whereas it seems to me, again, with a lot of the headwinds passing, we're moving through back to that sort of fundamental stage where, almost, for me, quite exciting going back to sort of feels like a trader many years ago again, when we're talking about looking at each data point. What does that data point mean for the economy? What are the earnings mean for the individual share? That seems like, it seems this has been trumped, for want of a better word, in recent years.
Well, it feels like timing is everything. So what key data points should traders be watching next?
Well, this week we've got retail sales, and we've also got the Michigan sentiment. And then I'll go on to sort of a few other points a little bit later. But actually, there's one point I wanted to mention from earlier this week that I thought was really interesting, again, as we get into that analysis, the actual data. We had a lot of Chinese data out both Monday and Tuesday. So Tuesday, GDP's up, very good. And we had industrial production and retail sales both out. So expecting 5.6% for both. So again, sales matching production. We've seen industrial production grow 6.8%, whereas retail sales are not rising by the same amount. So I'm really watching that gap as a sort of a good sign, is then going, that's got to be Chinese exports, Chinese, for most of the noughties, exported inflation. And I'm really hoping we see that again.
So if we zoom out a bit, do you think the US is still the main driver for market sentiment right now?
I suppose yes, probably not as much as it was.
Okay.
When we've seen over the last couple of months, again, due to the tariffs and concerns, that there's been massive outflows from the US equities markets. They're still buoyant, but again, the amount of money going into them isn't the same. So we're seeing a real switch now going into European and international equities, which again will be a refocus on where to look at for the data. But as I said, again, what data have we got next week? We're back in earnings season, so
lots to discuss.
Yes, exactly. So we've got Amazon, Apple coming up in a couple of weeks, and we've got Netflix coming out tonight, which is going to be a big one. So there still is that focus into it.
And just to wrap things up, what are some other stocks and sectors that we should be looking out for right now?
Well, this is what I was sort of saying earlier. I find it's quite exciting. Whereas we're going away from going, oh my God, what is big tech doing? What is America doing? We're not leaving that alone at all. But it's almost opening up the full range of markets. So the two sectors I've been sort of looking at in particular, banking. I think we've seen some really good signs. Again, we've had results up this week. Every big US bank that has announced results has been outperforming. Mm-hmm. And from that perspective, I think when we're looking at banking, there's a lot of politicians talking about deregulation. Politicians are trying to find growth. Where are they going to find it from? Deregulation is there. So for me, the banking sector is rock solid, okay. And almost a good sort of sign for what's going on in the economy. As I said, we have Netflix out tonight, and talking about that as a sort of another bellwether for the economy. So that's going to be fascinating. And then lastly, that I'm looking at the automotive sector.
Okay.
So again, it's
why automotive?
Well, it's almost been the worst sector you could possibly invest in over the last few months, also in months and years. Where looking,
I was going to say years, but
yes, exactly. I was looking at Porsche last year was at 120, and we hit low of 40, and now 93. So again, for a company, Porsche was almost the sort of poster child of profitability in the car industry.
Yeah.
And it just shows you how far even they have fallen. So we've got Porsche results out at the end of this month, and it's going to be fascinating just looking for some revival again, that idea of looking at individual stocks again, rather than just sort of big plays on the global economy and shocks, just to see if there's a bit of value that's a ray of light that's going to show some value.
I like your optimism. Thank you, Alex. And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.